Hello everyone, I hope you are doing well today. Welcome to this new video on Renko chart. We will study what it's about, the different strategies, and we will also analyze a detailed backtesting. So, we will start by understanding Renko's graph. We will then study a strategy based on this chart, which we will backtest, to finally come to a conclusion. Okay, let's start by understanding what a Renko chart is and how it is built. Here is what a Renko chart looks like. You should know that it focuses mainly on trends. We put green boxes for uptrends and red boxes for downtrends, as you can see here. Time is not taken into account. The chart only focuses on the price and the trend. This means that, for example, a box can last several days, or even several months if the price does not vary. Let's now understand how Renko is built. First, you have to choose the box size assignment method. There are three main methods: the traditional, the percentage, and the ATR, which means average true range, and which corresponds to the volatility of the asset. Once we have chosen the method of assigning the box size, we have to choose the box size itself. That is to say, we have to choose what corresponds to a green box and a red box. If we have chosen the traditional method, we have to assign a size corresponding to a dollar movement. If we have chosen the percentage method, we have to choose a percentage movement for the size of the box. And, if we have chosen the last method that corresponds to the ATR, the size of the box will be based on the volatility. Finally, the user of the Renko chart has to choose the source of the price, that is, the closing or OHLC, which corresponds to the average between the opening, the high, the low, and the close. Okay, let's see now an example to better understand how to build a Renko chart. The rules chosen are for the box size assignment method, traditional. For the box size, it's $1, and for the source, it will be the price closure. So here we have a start of a Renko chart. We see that today the low of the last box is at $20, and the high at $21. Here an important rule. To add a new box to the chart, the price must reach the next top or bottom level that I have displayed right here. So either level 19 to build a red box, or level 22 to build a green box. On day 1, we see that the price has reached $22.15, which means that it reached this level 22, and so we can build a new green box. We display it right here, and we modify the next levels to reach. On day 2, the price is at $22.70, so it didn't reach the next level to build a new box. We don't add a green box. On day 3, the price closes at $24.50. It's a big move, and so we can add 2 green boxes, because the price reached both level 23 and level 24. On day 4, the price closes at $22.10. Nothing happens because none of the next levels are reached. On day 5, price closes at $21.10. The 22 level is reached, so we add a red box. And so on, and so on. Okay, now that you have understood how to build a Renko graph, we are going to study a strategy that will allow us to have an edge on the financial markets. The strategy is very simple to use and is called each reversal strategy. It consists of following the signals that Renko sends us of the trend changes. That is to say that as soon as a new box of a new color appears, we follow this new trend. As you can see on the graph here, we enter a long position for the uptrend and a short position for the downtrend. Be careful. Not all signals are necessarily winners. Let's analyze all of this on TradingView. Okay, so we are on TradingView, and we're going to analyze the crypto Litecoin today. To display a Renko chart, you have to go here, in the Chart tab, and select Renko, right here. We have selected it, and then we can change the parameters by clicking here. In Settings, Symbol, and we have access to all parameters: the source, the box size assignment method, and the box size. And here we go. Let's now look at the signals that the strategy each reversal sends. For example, here we have a reversal, Indeed, we go from a red box to a green box, and the signal appears above the first green box. It's because this box is only added to the chart when the price reaches this level, so we have our long signal here. At this level, we have a short signal, followed by a long signal here, and so on and so on. We can see that this strategy is very easy, and that the signals are very clear. Let's take a closer look at the strategy's performance with a detailed backtesting. I would like to start with some key points. Number 1. To have an automatic backtesting on TradingView, we have to code a script, which I did. But the TradingView scripts require time, that's why I take time into account in the Renko chart. So if nothing happens during a candle, I mean if no new boxes are to be added, the same box is plotted next to the previous one, as we can see here. Nothing happens during these 8 candles, and so we plot 8 boxes side by side. And if the price closes in a way to create 2 new boxes, then these 2 boxes will be superimposed. We can see on this image that there was a strong movement during this candle, creating 2 new boxes, which will therefore be superimposed. Let's return to TradingView to analyze the strategy's performance. We have here our classic Renko chart. If we want to backtest the each reversal strategy, we will go to the Indicator tab. And we will type Renko Strategy. We see that there are several scripts from the community, and mine corresponds to this one, where my name appears here. We click on it, and the Strategy Tester tab opened up. TradingView gives us a message indicating that, on non-standard charts, like Renko, there are unrealistic results. That's because this chart doesn't take into account the time. We must therefore change it to a chart that takes time into account, like a candlestick chart, for example. And that's it. So then, what we're going to do is set the parameters of the strategy. So we click on the strategy settings here. You should know that the box size assignment method is by default traditional. The source, so the base price, is close, but you can change it. And we're going to set the box size to $5.08. Because performance is best with this parameter. Then, the fixed ratio value corresponds to the amount of earned money which will allow us to increase the size of the position by $200, so this quantity here. It's money management, and we're going to leave the default settings. And the backtesting period, we're going to change it from 2020 to 2027, to be sure that today is included. And in the properties we can see that the initial capital is $1,000. The commission is 0.18% per trade, and that we have a slippage of 3 ticks, that is to say, 3 cents for this financial asset. We then press OK, and we have our Renko strategy, which is ready to be backtested. So let's open the Strategy Tester tab to have access to the performance of the strategy since 2020 until today. This curve is our equity curve. That is the evolution of our account capital. We can see that the strategy has generated 338% out of 148 closed trades. We have a win rate of almost 46%, a profit factor of 1.22, and a drawdown of 41%, which is what makes the strategy so risky. And I will explain why. It's a characteristic of the Renko chart, because the source we have chosen is the price closure. It means that the new box of the Renko chart will only be displayed on the chart at the price closure. This principle can be illustrated with the last trade that we opened. We see that there were 2 boxes of Renko, which were created during this huge candle. But these 2 boxes only appeared on the chart when the candle closed. The buy signal was therefore created at the top of the first box, I mean here, but the order is not executed until the next candle opens because we're waiting for the candle to close to be sure that the signal is confirmed. We enter the position a little later than what Renko chart would have told us. It's because of the source chosen, which is the close. That's why we lost almost 17% on this trade. The signal has been delayed, and instead of exiting at 121, we exited at $127. This principle is called repainting on TradingView. Let's analyze the results together. The total number of closed trades is 148. The win rate is 45.95%, which means that almost 46% of past trades are winning. The profit factor, which is the ratio of our gains to our losses, is 1.22. The max drawdown, that is to say the maximum loss, is 41.47%. The total profit is 338.9%, while the buy and hold strategy, that is to buy the asset in 2020 and keep it until today, would have generated only 157%. The strategy can therefore be very risky, but it can beat the market for certain assets. I don't use Renko anymore because the risk is too high due to delayed signals for no repainting purpose. Let's finish this video with a quick conclusion. We have seen that Renko chart focuses mainly on trends and not on time. It is very similar to P and F chart, but it's reversed much more easily because one single box is enough to change the trend. The each reversal strategy is very easy to implement and sends very clear signals. And finally, the Renko chart can, in some cases, beat the market, but by taking huge risks for that. So I do not recommend using this graph, except if you are ready to lose up to 30 or even 40% of your capital. Okay guys, thank you very much for joining me in this video, and I'll see you very soon for the next class.